Three stocks, the September 2019 edition. Let's get started. What's up everyone, my name is Ale. Welcome back to my world of stocks. As always, this monthly series is not a recommendation to buy or sell anything. I'm just trying to teach you guys about three different stocks every single month. And we try to categorize these as one high risk stock, one medium risk stock, and then one low risk stock. But obviously every single stock in the world has a lot of risk associated to it. So make sure that you always do your own research, plenty of research, and then make your own decisions. But if you guys enjoy this series, make sure you hit the like button. That really helps support the channel, helps it survive and grow. But with all that said, thank you for clicking on the video. Let's go ahead and start with stock number one, and that's going to be our high risk stock. All right guys, now this is one that I've been receiving a ton of comments on recently, asking me to talk about this one. And the reason why is because this is a stock that has been crashing by a huge amount lately, but it's also a stock that a lot of you say that you're invested in or that you're really interested in investing in, so you wanted to hear my opinion on the company. And that company is of course Align Technology, ticker symbol ALGN. And they're famous for creating and designing many different medical devices in the market, but they're mostly famous for their Invisalign clear braces for your teeth, and those are very popular these days. Now there is actually a lot of growing competition in this space, but Align is really the market leader because they're very much so a global company, whereas a lot of their competition is kind of local. So Align is really the market leader across the globe in many different countries, and they hold close to 500 different patents globally, so that's a lot of patents. So it's very tough to actually knock them off from the top. Now taking a look at the stock, they're still up by over 226% in the past 5 years, so any early investors have still been rewarded very well for their investment. However, if we look at the past year alone, this is a stock that shot up to nearly $400 a share and has since taken a nosedive all the way down to the $170 range, losing well over half of their value, where they now sit at rock bottom levels of their 52-week range. And a lot of this damage has been taken in recent months, as they're currently down by over 45% in just the past 3 months alone. A lot of this has to do with their most recent earnings that sent the stock crashing by 27% in a single day. But at first glance, those earnings didn't really look all that bad, or at least not nearly bad enough to cause such a huge drop. In fact, sales actually increased by 22% year over year, while also beating guidance, and their EPS climbed by 40% to $1.83 per share versus expectations of $1.53 per share. However, I did some digging into their earnings report, and it turns out that this quarter benefited from a lawsuit that gave them an additional 57 cents of EPS, so adjusting for that settlement, they would have actually dropped year over year by around 3%, which is definitely not as good as previously thought. On top of that, they guided for EPS to only be $1.13 next quarter, which is about 28% lower than what analysts were expecting. So that's a huge miss there. As far as the reasons why, their earnings report states that it's primarily due to softness in China, and because the uncertainty of that market, they're being more cautious with guidance in the Asia Pacific region. That's a big deal because I believe I heard the CEO say once that China is their second largest country as a market. Still, even if margins are being damaged right now, which is affecting their profitability, their sales are still growing by decently large amounts. In fact, their scanner and services segment grew by a massive 82% last quarter. And while it makes sense to have weakness in China, given that practically every global company out there is using China as an excuse for weaker guidance, Align is actually seeing stronger growth elsewhere. Notably, the CEO mentioned during an interview with Jim Cramer that they only received growth of 20 to 30% in China, which is still very high, but it was extremely lower than the 70% growth that they were expecting. But they still think that there's a lot of potential there, and already have solid growth elsewhere of 39% in Europe, with 50% in France, 50% in Spain, 35% in the UK, also growth of 34% in the Asia Pacific region, with growth of 50% in Japan, 70% in Taiwan, and then they still have over 100% growth in Brazil. So this is by all accounts a still very high growth global company. In fact, Yahoo Finance projects revenue growth of over 20% both this year and next year, with their EPS still growing a little this year at 5% despite the recent struggles, and that should improve to growth of over 23% next year with a 5-year average of almost 20%. Obviously, those targets may not be easy to hit, but when looking back at China, they're working very hard to turn things around in that market, as they've just trained close to 200 new doctors in the APAC region to use their products and services, with over 40% of them being in China, and they're also investing in their facilities, their centers, and their advertising campaigns in the country so that they can operate like more of a local company that can attract the Chinese consumer base to give them a try. In the meantime, the sky-high valuation has come down to more reasonable levels, even though I still consider it too expensive for myself, but their forward PE ratio now sits at under 28, while their PEG ratio has broken down to less than 2, thanks to that expected earnings growth over the next 5 years. For me personally, this is still a very expensive stock when looking at their valuation, and they don't even pay out a dividend. So for me, it's a stock that I'm only willing to watch at this time. But if they were to drop like another, say, 10 to 20%, it's a stock that I would definitely consider buying myself, but I would have to see a little bit more of a drop there because I still think the valuation is very high. But at the end of the day, this is still a very high growth company, and they do have a lot of issues right now, but I think that they are issues that could be fixed in the future. And so for those reasons, it's a stock that I will continue to watch very closely. And if I ever do decide to buy the stock, I'll be sure to let you guys know. And if you guys do want me to make any update videos on this stock, let me know down in the comment section below. Alright guys, moving on to stock number 2. This is going to be the kind of medium risk stock that we're taking a look at this month. And this is the most popular casino stock out there, at least here on YouTube. Especially here on YouTube, it's very popular. And I get asked constantly to give my opinion on this company and on this stock, and that is of course Wynn Resorts, ticker symbol ticker symbol WYNN. And this company has some very popular, very expensive, and luxurious casino resorts. They have a couple out here in Vegas. They have some in Macau, China, which is where a lot of gambling takes place in Asia. And they also have a brand new one out in Boston, so out on the East Coast as well. Now, taking a look at the stock, we can see that they've been pretty volatile over the past 5 years, having a huge crash in 2014 and 2015 before surging even higher through 2018, at one point even breaking north of $200 a share before crashing right back down and losing about half of their value, where they now trade for just a bit above the $100 a share mark. As far as their valuation goes, Yahoo Finance gives them a trailing PE ratio of less than 14, a forward PE ratio that is just a little bit above that, and a pretty reasonable PEG ratio of 1.19. So overall, I'd say that it's a pretty attractive value at this point. Keep in mind that you also get a very attractive dividend in return with almost a 4% yield. Although to be fair, it looks like it only has 2 years of growth with a negative 5-year average. So this may be a pretty volatile dividend, as their payout history is kind of all over the place, at least according to Seeking Alpha. In any case, the stock mostly tumbled, in my opinion, due to the weakness in Macau, China, which is like the gambling mecca of Asia, and Wynn happens to own a couple of major resorts in that region. Now, if we take a look at the overall gambling revenue being generated in Macau, we can see that it dropped by a huge amount in 2015 and 2016 before starting to recover the years after. And this completely correlates with Wynn's own revenue, which also took a dive in 2015 before starting to recover in the years to follow. Still, Macau has been under a lot of pressure again lately due to the weakening Chinese economy that is further hurt by the entire trade war. On top of that, Wynn has seen rising costs, mostly associated with their new resorts and casino that they built out in Boston for a whopping $2.6 billion. And because the resorts only opened a couple of months ago, it makes sense that their bottom line is still feeling the effects. In fact, their EPS is expected to drop by 21% this quarter and 7% for the entire year. But despite all this, I'm actually a bit optimistic on this one because I don't think that there's anything fundamentally wrong with their business over the long term. In fact, their EPS is expected to recover by almost 50% the following quarter and 21% the following year, with a 5-year average of almost 15% growth, all of which should help sustain the dividend, assuming that we don't go into a recession. And when looking at their sales, they may only be expected to climb by 2% this year, but that should rise to almost 10% next year. And if a trade deal gets done and China's economy starts to improve, coupled with our own economy influencing Vegas and the new resorts in Boston, all of that should eventually help sustain that revenue growth in the future, assuming that those things go or move in a positive direction. But for me, the reason why I still consider this stock to be a little bit too risky is because they're so heavily tied to macroeconomic conditions. And whenever we have a recession, usually the first thing that gets cut is leisurely spending. So I could definitely see their revenues and their profits struggle during difficult macroeconomic conditions. And that's not really something that I like to be exposed to. It's not a huge concern because if you look at it on the flip side, there's nothing really fundamentally wrong with their business, yet the stock is being kept low at this time because their business is kind of struggling during these conditions. But during other conditions, they could be performing extremely well because, again, there's nothing really fundamentally wrong with the company. And I actually like all of the moves that they're making, and I like the fact that they're trying to be ambitious and trying to grow a market out on the East Coast as well. So I really like this stock. It's not one that I'm picking up right now, but it's definitely one that I will keep a very close eye on. Let me know if you guys are invested in Wynn Resorts or if you're thinking about it down in the comment section below. Alright guys, and that brings us to stock number 3, and this is going to be our lower risk stock of the month. It's still a little risky in my opinion because the valuation is very high, but for their enormous size, they're actually still growing at a pretty decent rate. And they also stand to benefit heavily from the fall of physical cash use and the rise of e-commerce online shopping. And that which are, by the way, things that I think will get bigger and bigger in the future. But that company is, of course, Visa, ticker symbol V. Now, they're obviously a payment services giant. I'm sure you guys have heard of Visa before. But the great thing about Visa is that they don't really carry the same risks as something like a bank does. I often see this as a misconception about Visa, is that they carry the same risks like changes in interest rates or customers not paying back their debt. And it's not really true. Visa just acts as a sort of middleman. So if you were to try to access your funds from your bank account or you want to use your credit card, the bank is really the one that takes all the risks associated with that, while Visa just takes a small fee for you using either their card or their services every time that you do one of those transactions. Now, where I do actually see some risk for Visa is in the stock price because it's currently trading near all-time highs. I personally wouldn't buy the stock unless we saw a big pullback, but the thing is that Visa is almost always trading at all-time highs, so getting a large pullback is somewhat rare. Having also said that, I think that makes any pullback in the stock even more special, and therefore I come back to my original argument that it's better to wait for one of those rare pullbacks or dips and take advantage of the stock price at that time. Regardless, they are currently up by almost 240% in the past 5 years, with one of the smoothest uptrend lines out there. Even if we zoom out to the past decade, the story is pretty much the same. As a result, their valuation has gotten a lot more expensive, as Seeking Alpha gives them a forward P ratio of 33. Although to be fair, the sector median isn't too much cheaper at 29, and their PEG ratio is also just a little bit above the sector median as well. That's not too bad considering the great performance that you get in return. Sales have been soaring for years now and are expected to break north of $25 billion next year. These are double-digit growth rates that we're talking about during what is clearly a global economic slowdown, with recessions happening in Europe, uncertainty surrounding Brexit, a major slowdown in China, and a very serious trade war between the two largest economies in the world. So for a global finance company to be growing sales by double-digit percentages during these very difficult or uncertain times, it's actually very impressive. Even their profits have been soaring, reaching a new record last year of over $10 billion, and their EPS is expected to continue growing by 17% this year, 15% next year, and an average of 15% over the next 5 years. In my opinion, a lot of this is thanks to the fall of physical cash use and the rise of e-commerce. When looking at cash, it still gets used heavily, especially in poor communities, but across the board, the use of cash has been steadily declining, while debit cards and credit cards have been on the rise. And when looking at e-commerce, there's no real way of using physical cash for online shopping, so that tremendously helps companies like Visa or MasterCard. But that market is expected to reach nearly $5 trillion by 2021, yet that would still be less than 18% of all retail. So there's still a lot of room to keep growing there. And China alone was worth over $1 trillion last year, and that's a market that US companies like Visa and MasterCard are still trying to tap into in a meaningful way. So couple all of that with recent investments in innovation like blockchain technologies, Visa Direct that allows real-time payments for consumers, businesses, and cross-border transactions, a new partnership with Coinbase to allow cryptocurrency use through a Visa card, and they've even showed interest in joining the Libra Association, which is behind the upcoming Facebook cryptocurrency, and you're left with a very exciting company for the future. But putting all of this aside, Visa is also a pretty good-looking dividend growth stock as well. Now, to be clear, the yield is laughably low at just 0.5%, but as a dividend growth stock, it absolutely meets all the other criteria with a really low payout ratio of less than 20%, an amazing growth rate of over 20%, and over a decade of consecutive growth. And with their incredible margins, I would assume that these dividends are going to continue to be paid over the long term. And so when I look at Visa, I see a very solidly run company that I really like and one that is making all the right moves for the future. But one of the concerns that I have, or one of the problems that I've often had with this stock, which has kept me from buying it, is that it's pretty much always traded at all-time highs. And as you guys know, I very rarely buy stock when it's trading at all-time highs unless I'm really, really in love with the company. And in the case of Visa, it's not like I absolutely need this stock to be in my portfolio. So for those reasons, I really wouldn't be willing to pick up this stock unless it dropped by maybe another 10%. At that point, I'd be very tempted to pick up Visa because that would increase my upside potential, and it would also give me a very solid dividend growth stock to go right along with it as well. So for those reasons, I still really like Visa. It's a very stable stock. It could be a very good core position to someone's portfolio. I just think it would be nice to be able to pick it up on a little bit of a dip rather than picking it up at all-time highs. But that's just kind of my personal opinion. I'm sure a lot of people disagree with that because this is a stock that has proven me wrong for a very long time because every year I'm not willing to buy the stock, and every year it just continues to shoot up. So anyway, Visa, stock number 3, one that I really like, but I'm not picking up just quite yet. Anyways, let me know what you guys think about any of these 3 stocks. Thank you so much for watching the video. If you enjoyed it, make sure that you hit the like button. It really helps me out a lot. Thanks again. I'll catch you guys in the next one. Take care. Bye-bye.